Hello everyone, welcome to another exercise series. In this series, we are going to be looking at chapter 8 exercises from our Managerial Accounting course, ACCT 4 to 8. Starting off with this video, we're going to be looking at exercise 8-1A, the first exercise. So let's read the exercise together. It says, Cherokee Manufacturing Company established the following standard price and cost data, and we have a table that shows sales price, variable manufacturing costs, fixed manufacturing costs, fixed selling and administrative costs. And then it goes on to say Cherokee planned to produce and sell 2,000 units. Actual production and sales amounted to 2,200 units, which happens a lot in manufacturing businesses. As you can see, we have a variance between the planned production level and the actual production level. All right, so what's required? A, prepare the pro forma income statement in contribution format that would appear in a master budget. Okay, so that's the first requirement. Second requirement, B, prepare the pro forma income statement in contribution format that would appear in a flexible budget. Now, as you can see, both requirements seem to be similar, but we do have one main difference, is that here we're going to be preparing, in the first requirement A, we're going to be preparing a master budget, which basically assumes the planned level of production, okay? Whereas for requirement B, we're going to prepare a flexible budget based on the actual production level. So we can do this or complete those both requirements in one go. As I've prepared here, as you can see, I'm going to create the income statement in a contribution format, but instead of having just one column for the price / cost per unit and the master budget, and then redoing the whole thing again for the flexible budget, I'm going to have them side by side, and we'll complete A and B in one go. Okay, so how do we start the pro forma income statement? Of course, we started with the sales figures. So we'll start with the sales line. Okay, and we'll go back here and see what's the selling price. As you can see, it's $12 per unit. Okay, so I'll come here to the price / cost per unit and write down $12. Okay, based on that, what would be the sales according to the planned level of production? If we assume that we only going to be selling 2,000 units, we'll get our calculator, 2,000 multiplied by $12, and we'll get $24,000. Whereas based on the actual level of production, we will multiply $12 by 2,200 units, and we'll get $26,400. Okay. Next, because we are preparing the pro forma income statement in the contribution format, that means we're gonna add another line here for variable manufacturing costs. Okay, so we'll say variable manufacturing costs. And again, we'll go back to the data here and see what is the variable manufacturing cost. It's $7.20. So I'll write that as it is right here, $7.20. And again, I will calculate what would be the total variable manufacturing costs based on the two levels of production that we have, the planned and the actual. So first off, 2,000 units multiplied by $7.20, we'll get 14,400. Okay, whereas $7.20 multiplied by 2,200, which is the actual level of production, we will get $15,840. Okay. Now we can close this off to calculate the contribution margin. I'll just put a line here. Okay. And then contribution margin, and calculate for the per unit line or column. The contribution margin per unit is going to be $12 minus $7.20. We get $4.80. For the master budget, we have 24,000 minus 14,400. We get $9,600. And for the flexible budget, 26,400 minus 15,840, and that's going to give us $10,560. Okay. Next, we move on to the fixed costs, and as you can see, we have two fixed costs. We have the fixed manufacturing costs of 3,600, and we have the fixed S&A costs, or selling and administrative costs. So I'll include both of these. Okay. We'll start with the fixed manufacturing. Costs. Okay, and then fixed S&A costs. Okay. We don't have to write these in a per unit basis, so we'll leave the first column blank and we'll write them as they are for both in the master budget and in the flexible budget, because these most likely did not change. At least the question did not give us any changes to these figures, so they will repeat for both master budget and flexible budget. So for the fixed manufacturing cost, 3,600. Write it down here as it is, and here as well for the same amount. Okay, and the fixed S&A, 1,200. Again, same thing under the master budget and under the flexible budget. It's going to be the same. Now we can calculate the net income for both the planned level of activity and the actual level of activity. Okay. I'll run the numbers for the master budget. 9,600 minus 3,600 minus 1,200. And that will be a net income of $4,800. Okay, let's write net income here. Similarly to the flexible budget, 10,560 minus 3,600 minus 1,200. And that will be $5,760. Okay. And that would be it for this exercise. This would be the answer to part A. And this would be the answer to part B. And again, you can do this twice if you want. Like you can create the pro forma income statement for the master budget first and leave this alone, complete this, and then repeat the same process for the flexible budget. But it's not really necessary. You can do it the way I have done it right here. Just include an extra column and add the flexible budget level of activity, and based on that you can create both pro forma income statements in one go. Okay, I hope you found this video useful. This is how you solve an exercise similar to this exercise 8-1A. If you have any questions, please feel free to drop them down in the comments, and until I see you in the next exercise in this series, take care.